Welcome to Investors Insights. Today's topic is be careful what you wish for. With the Fed meeting this week, we thought that was an appropriate title because the market participants for many, many months have been wishing for what's called a Fed pivot or pause, where the Federal Reserve would stop hiking rates. And we may just get that. This is likely the least clear the market has been on where the Fed is going to go just 2 days out from the meeting. Typically, the market is fully priced in what rate expectations will be, but there's a lot of debate on where rates are going to be. And why is that? And that's because there's a lot of concern around the banking system over the last few weeks. And so that's why, we said the title, be careful what you wish for, because we've been wishing for this Fed pause, but it may have come at the expense of the banking system. So that's a lot of give and take there. They were watching over the weekend. There was a shotgun marriage between the two Swiss banking giants, Credit Suisse and UBS. UBS will be buying its weaker, smaller competitor, Credit Suisse, with the support of the Swiss banking system. And the market is taking that as a positive, that we're doing all the right things and firming up our banking system and firming up capital worldwide. What'll be very large is watching what the Fed says after their meeting. There's an argument between a 25 basis point hike or no hike at all. And so what the Fed says behind the reasoning could reassure markets, because the Fed sees data that we don't see. And so if the Fed is confident in our banking system and is confident in the strength of our economy, then that'll probably do a lot to boost market expectations. In addition to that, inflation came out last week at 6%, in line with expectations. So the Fed is really kind of getting what they wanted. Inflation coming down, not at a real fast pace, but more importantly than what we expect. What do markets? The bond market is really the leading indicator of what the Fed. So Ty, you this morning, I appreciate all the work you did in our discussion. You brought up some really good charts on where the bond market and where we see interest rates since the most recent banking news came out.
So as you see in this chart, the 2 and 10 year, we've had a lot of volatility in the bond market. It's almost traded like the stock market in a sense. And so as you see here, the curve is flattened considerably. Rates came down. The 2 year was at about 5%. Now it's at 3.86. This is all in a span of about a week. The 10 year was at 4%, now down to about 3.43. So we went from kind of like a 100 basis point difference between the 2 year and the 10 year of that inversion to now about like a 40 point basis differential. And so what does that mean? Well, traditionally, the 2 year yield, once it goes below the Fed's funds rate, is typically when the Fed kind of looks to pause or start cutting rates. And now we see that the twos have come down. They're down about 50 basis points below the current Fed funds rate. It'll be interesting to see, as you alluded to, what the Fed's going to do this week with the banking system going on as well. And then as you see here in the span of one business day, that is, what the Fed funds rate looked like before Silicon Valley and then afterwards. And so we have dramatically changed from having steady rate hikes throughout the year, and then maybe one rate cut or more of a pause to pricing in, cuts coming along as soon as, middle of the year here. So it'll be interesting to see what direction the Fed goes. And I think that's where all our eyes will be this week.
Yeah, and this has direct impact on our clients because what the Fed does has proven to impact the stock market. If the Fed pushes rates higher than necessary, the stock market falls. We really need a more accommodative Fed to see the market start to rally. In addition, we've seen interest rates rise over the last year. The 30-year mortgage went from in the mid 2s all the way up to above 7. That directly impacts clients looking for homes. And so as we see interest rates fall, you should expect to see potentially stocks stabilize and rise. And you could see mortgage rates fall, which could help the housing economy and help borrowers and help our clients who are looking for houses. So a lot of news coming out this week that will have a large amount of impact on where the markets go from here. Where inflation goes from here and where interest rates go from here. So it's definitely a very big week. We'll be watching it closely. Please do not hesitate to reach out to us if you have any questions. Please don't forget to follow us on social media, Facebook, LinkedIn, Twitter. I hope you have a great week. We look forward to keeping you informed.